welcome back. We are now on chapter 4 of Simple Numbers, Straight Talk, Big Profits by Grade Crabtree. This is part 2. If we didn't watch part 1, check that out. So last we were talking about is how we could take deposits up front to save us in a cash flow crunch. So I want you to kind of think a little bit differently on this one here. Now, imagine this. Okay, I like to eat a lot of great food. No surprise, right? But sometimes my wife makes a good old skillet dinner. Something in the skillet. You come home and it just smells great. Well, my son is a growing kid, but he goes to the skillet to get his own meal sometimes. He always asks one question. Has Dad ate yet? You're probably like me going, I can sympathize with that. Because if my son goes and takes too much, I'm not going to have enough and I'm going to be angry. I want you to use that same kind of analogy when it comes to paying taxes and saving money. You need to make sure that when you're going to that skillet or you're going to your business, you're not taking out the pieces that need to be saved. So if you save some for Dad, all right, or save some for Mom. And guess what's crazy is, if Dad already ate and doesn't need it, you can save that for leftovers and for another meal. So now all of a sudden you made it stretch further. It's the same kind of thing in your business. When you carve out things to set aside for later, it will help you out tremendously. Otherwise, you could end up saying, I'm going to eat like my son has done before. I'm going to eat it all thinking Dad has already ate. And all of a sudden I come home and I am hangry. Can anybody understand what that means? And all of a sudden I got to figure something else out. And my son, I wrestle him to the floor. And I can't do that very much anymore because he is 14 years old, 6 foot tall, and 240 pounds. Holy moly. But I can still get him down. So let's kind of move on here. So that's all I wanted to kind of talk about is saving things aside. Could be simple things like saving aside for taxes or for emergencies. Now let's talk about debt. I gotta tell you, I gotta be honest. I am not perfect, okay? I am not coming from this as a point of authority. Just because you're watching this doesn't mean that I know it all and I've done it all right. It just means that I'm willing to learn how to do it better. So let's take that journey together. Some of these things on debt. Why do we get in debt into our company? A couple of different reasons. Either because we're buying something we need, or because we're buying something we didn't think about. So one thing to think about is, we're taking on debt. Is it because we are planning ahead or because we failed to plan? So are we taking on debt because we're planning ahead or because we failed to plan? Let me give you a great example. We're planning ahead. We're buying a piece of equipment that could do things better for us. Like when I first started out, it was just me and my own pressure washer. Actually, it's a funny story. I bought it off Craigslist. And they said it worked great, except the pump might not work. Okay, I could probably fix that, I would think. I don't know. I bought this little thing for, was it like $400? And then the pump didn't work, and found out the pump itself was like $600, a little AR pump. And I had to fix that, take cash out of my family's business, or my family, not the family business, to fix it. And I was like, son of a gun, if I'd have thought a little better. One of the things is, I came into this to start my company not with cash. Okay, I didn't start this because I'd saved up my money and now I'm going to start a business. That's not my personality type. If you're like me, who acts before they think, or if you've ever been told growing up, you don't really think much before you act, you could be like me, and you're the kind of person who says action is easier than thinking. So in this case, you might be incurring debt, or have already got debt, or considering debt because you didn't plan like you could have. Hey, I'm not being mean or anything here. I'm just saying that sometimes our personality types of a high risk, what do they call it? High risk adversity? Personality likes, a person who just doesn't think, excuse me, we can get ourselves into a bind here. One thing I might recommend, other than just reading like we're doing right now, is surrounding yourself with personalities that think different. In this book, this accountant thinks much different than me. To me, the people who kind of slow me down on my progress are my accountants and HR. They just seem to want to tell me what I can't do and why I shouldn't do that. Well, I'm the kind of guy who says, well, watch me. That doesn't always work out right. Let me kind of share a little bit here, okay? Let's just start with the story. This was a scary one that really scared me. This really got me thinking. This really made me think of, what am I doing? This really made me think of, could this happen to me? Let me tell you. So a buddy of mine, great guy, Josh, up in Kansas City. he had helped other people get started by just kind of mentoring. It's a great idea. If you don't have a mentor, you need to find one. If you don't have a coach, I recommend looking for one. For me, I found a mentor by calling people way outside of my service area and saying, would you train me? I want to start a business. Sometime I'll share more of that story. But this guy, Josh, being a great guy, said, yeah, I'll train you. I said, I'll even work for free. This is more valuable to me to know what I don't know, right? If I could just somehow know a little bit more things that I don't know, to me, it's less risky. So I went up there and worked for Josh for a couple of days, literally. He's a great guy. We even got breakfast together, showed me how to... It's a great guy, okay? And I said, can you support a family in this? And he's like, well, I got multiple kids. And he does. They're all great kids. I've been watching them grow. But he shared with me a story a little later on. And I listened to his story because I trusted him, because he's my mentor and my friend, and because I know he's helped other people out as well. Here's the story. He helps someone get started, and they're doing a truck washing. Truck washing is a hard work job, okay? It's not like magical. We're not wearing swimsuits like you do in the movies, you know. We're out here grinding away, washing trucks. And this person had started a company and got a lot of contracts. So this is kind of nice, reoccurring revenue. I know I'm going to be making money every single month, and I get my revenue is based on how many trucks I wash, or how many's in the fleet, how many's there. So this person did that, but his contracts started growing. And his very first truck he had to finance. Woo! I got a truck. It's going to be great. I'm going to go out. I'm going to spend a real nice one because I'm going to look really good. It's going to be a good branding issue. We've all said that, right? And then I need to get this kind of equipment because it's going to go faster. And we can say all these kind of things. I'm not saying it's wrong, but I'm just saying, listen to the story. So he financed his first truck and equipment. Then you find out these contracts are growing. He got to $2 million in revenue pretty darn quickly because these contracts had multiple sites. Well, to serve $2 million, he had to get multiple wash trucks. To do that, he financed every single one of them. On all the equipment, he financed all those kind of things too, and had multiple employees. This is where it gets scary. All that sounds fun. I can get good big contracts. I can gear up quickly. If I had a good relationship with my banker, it's important to have a good relationship with the banker, but to know when to use the banker. So he financed all those things and came into a thing called a cash flow crunch. So in reoccurring or in commercial work, I don't know if what kind of industry you're in or not, but with us, commercial work can pay 30 to 45 days later. And sometimes they'll really put it to you and say, I don't know what happened. We hired somebody new. We have new accounting practices. I put it to them. They just didn't pay it. And you can be like 60 or 90 days of payment. This is where it really got this guy in trouble. He tried to start financing these payments, okay? They owe me money. I haven't received it yet. That's called an accounts receivable, or abbreviated an AR. So he tried to finance these accounts receivable. But the problem was he was so heavily leveraged, he couldn't get loans to pay those accounts receivables. Now, there's a lot of things we could think of doing. I've done it before. Why didn't people weren't paying me? And I actually went to the door and said, hey, you need to pay me. And that's not always well received. Okay, you could lose your company that way, or lose that contract, or that customer doing that. And so I said, tell you what, you owe me money. Let's get it paid up here. I'll give you like 10 or 15% off, which is stupid. Typically, I only give 1 to 2% off for early payment of before that 14 or before 7 days. But in some cases, I had to go do that. But this gentleman in this conversation couldn't do it. And eventually, he went out of business. Not only that, but everything was personally guaranteed, which means that when you get a business, you really can't take out a loan against the business. This business hasn't even really done anything yet. So it's all on you, the owner, the personal guarantee. So this person scared the boo out of me because he started big real quick, riverside, and then went down real quick. And I think eventually now he's working somewhere with a GOB, which may or may not be what he's looking for. But the thought was, I don't want to do that. I don't want to get in that kind of crunch. How do I do that? Well, this is where it comes into doing. There's a couple of different ways people grow. Either by saving cash for everything. That's kind of, I wouldn't call it an old discipline, but it seemed like a lot of people, older people I know have done that really well. Then you kind of have this new thing people talk about is if you just get debt or finance all these kind of things, you can scale up quicker, go to the next level even faster, right? But that can also come back to bite us. So you have to really understand, what is your risk tolerance in this? And if you're the kind of person who's I can just take high risk, it doesn't matter. If you've got a family, you're putting them in that risk. Is it really appropriate to gamble with your family and in your future? especially if you're leveraging your business or your own personal assets, whether it be your home or things like that, or your own savings account, like if you rolled over your 401k and used all your money to start your business, is it really a good deal to leverage that against my family? We go, well, that's going to work. Will it? I'm not trying to scare you here, not trying to slow you down. Just put something in your thought process. This book has been kicking my butt because as I was talking to my lovely bride this morning of over 21 years, wait a minute, 22 years. Oh, excuse me, dear. I didn't forget about that 1 year. It made me think, I am not the best authority on this. We've accomplished some really cool things. I'm super excited about it, really blessed I've done that. Very thankful. But I needed to learn a few things. And this book right now is making me really think about those things. So let's kind of jump back into it. I want to share that story because it's very, very relevant to these things. Okay. So this book does promote cash, saving cash to purchase equipment and vehicles. But if you need a piece of productive equipment and you know how much more productivity and sales you're going to get from it, you can finance it with term debt, which is also a bank loan. This is not a credit card, okay? We're not going out and doing a payday loan. Can you imagine that? Thinking of who gets payday loans. I'm not saying anything bad if you got that in your own life in the past, but would we get a payday loan for a business? Absolutely not. That's way too risky, right? But payday loans were started with something good, but I'd say massively it's overused in a bad situation. So we got to think, is that what the kind of mentality we want to have in our company? Are we beer league, we talked about last episode, or something bigger? So if we're not going to be beer league, we need to take bigger and more important on these things. Because when you get a loan, this is what you understand is you have to pay it back. Duh, right? Well, where does that money come from? We talked about it earlier in the few chapters as our cost of goods sold, COGS. It takes all the money it takes to do the thing that makes the sales. And then we have all the other expenses. And the past is all your revenue minus all your expenses. What's left over is called profits, according to the IRS, okay? So all that money left over, you have to pay taxes on. And there's different strategies to try to pay less. But what I'm trying to say is all that money left over is your profits. Your bank loan payments come out of that money, the profits. Well, why is that? Because your bank loan payments aren't a business no, it sounds stupid. It's an expense I incurred in my business, but it's not as a business expense in here. Now, the interest you can deduct, but all those payments come out of your profits. So you're still going to pay after-tax dollars to pay off your debt. So it's after-tax dollars to pay off your debt on those kind of things. That's why it's kind of scary if you get too many debt payments. You're really robbing future profits. Or let me put it this way. If we need to figure out how to stay in business right now, is that because this is our plan or we failed to plan? That's a mental, I got to be able to take the kick in the butt to figure this out. But if I leverage more debt to pay for people that owe me money, accounts receivable, I'm basically saying I'm going to take my future money away to give it to me now to stay in business, which I can understand. I don't want to sink the whole ship right now. Or if we got a really, really good thing going, we got a really, really great, strong business. We need to understand, is that really the case? Or is our risk aversity, caught in our mind of making this decision? Because when you start making debt payments, that comes out of your money, of your profits, but then also decreases your ability to take money then out of the company's distributions. What do you mean? Well, let's just say after everything's paid over, you've got, let's say, $8,000 left over at the end of the month, okay? I know when you take distributions, you don't typically wait for a deadline. They say we should as discipline, but sometimes we don't. But you also had to pay $5,000 a month in debt payments. Now, holy cow, $5,000 a month. Yeah, I'll be honest. I made a lot of bad decisions. We've got about $5,400 per month coming out in loan payments for for our trucks and for our equipment that we've used to gear up and scale up. So I'm in that boat, right? So I'm not shouting everybody out. I'm talking about what I've made mistakes on, but we're still able to grow from that. So if I was taking $8,000 left over and I wanted to pay myself $8,000 and I just went ahead and took that money out of the business, but what about the other $5,400? What's going to come out somewhere else when the illusion of cash flow, money is coming to my bank, I don't quite see what this is going to do, because that's why I have to look at a budget to understand this all came in, this all came out, this is left over for this month, okay? That's where it gets confusing of the cash basis versus accrual basis. We talked about the last episode on accounting and looking at those things. If I have cash in my hand, I better have a plan. So if I take out my distributions plus the debt, I'm actually going this direction. And later on, we're going to find out, you're going to go, what happened? This is how we kind of stop that train before it runs off the track here. What I found out in the past, when I took out a loan to do some equipment, I could have used cash that I saved. Had I saved it, had I carved it out of the skillet and put it aside, I'd have had it for when I wanted to gear up or ramp up or scale up. But I financed it while I was still taking distributions. And so my accountant, as plain as he could say it, is, you basically got a loan to pay yourself. I didn't do that, but that's what the numbers actually showed. So if I didn't take out higher distributions, I would have had more cash set aside. I could have used that cash then to buy my equipment for the next thing and avoided the loan. But instead, ultimately it shows I took a loan out to pay myself. Well, that doesn't sound like a good long-term decision or solution, and it's really not. If you made that mistake, we can learn this together and get through this together, but understand this is what this book is kind of going to kick us in the butt. Hopefully you're staying with me on that. So understand that we are paying our debt with after-tax dollars, and we are robbing our future profits, but we need to make sure if we have that debt moving forward and we have debt payments, we need to build that into our budget to make sure that we got to really tighten our belt, which is cut expenses, or we need to raise our prices to bring in more revenue, make us more efficient, or bring in more sales. You just can't go to your customer and say, hey, I made some mistakes and I need more money now. You're going to owe me more money. That's not always the best method. And I don't think it's going to be well received. Would you do that to you if your contractor said the same thing to you? Like, oh, we had an agreement. So that's a different topic there of how we increase how do we charge more? Maybe we need to offer more in a different service, or we just start charging more and don't even tell them. That's something we'll cover later on. Okay, so let's talk about different types of loans here. Ugh, I don't like that, but sometimes we have to do it. This thing called a line of credit, I've heard a lot about it, but you got to have actually good credit to get a line of credit. In my former life, I was making sure it seemed like I was trying to make the lowest score. I don't know if I was playing golf or what with my credit score, but it didn't work out. So a line of credit. I know people who have these kind of things. This is something that can be helpful if used correctly, okay? Don't think of it as I now have a savings account because I have a loan, but think of it as it's being used for unusual circumstances, okay? In the book, it talks about two different examples. Someone who's in the medical business and someone who's in the restoration business. Those are both unique to me. I don't run any one of those. In the medical business, if you're say like a doctor's clinic, it could sometimes take a while to get paid by federal agencies like Medicare and stuff like that. You ever heard of when the government shuts down and they don't pay things? Yeah, these are the kind of companies who get hit by that. All of a sudden, you may not get paid this month, maybe not even next month, but maybe 3 months down the road, and then you get paid. What do? You still have operating expenses. You still got to keep going. This is when a line of credit can be helpful to finance basically those outstanding, unusual circumstances. Same way in a restoration business. That's like someone had a fire or a flood. They go help the homeowner get cleaned up and fixed up, and the homeowner can keep living. So in doing that, they get paid by typically insurance. And you know how fast insurance likes to act. Not always fast when they're paying people, okay? So if they drag their feet and they don't get it financed, all of a sudden this person could be out of work or money for 90 days. Same thing. They did the work, they bought the stuff, and they're now waiting on that money. That's an unusual circumstance as well, and that's where a line of credit could be beneficial, okay? I'm not saying you need one. Please don't hear me on that. But just saying that's what it should be used for. He also mentioned a line of credit should go back to zero. Okay, it should be, it says for at least for 30 days be at zero because you maybe took money out of it and you're paying it back. If you're using that as your constant savings account, banks will see that and they're not going to be wanting to loan to you in the future saying this person's just one bad business decision away from being out of business. So that's what a line of credit's for. Plus, one benefit is you're only paying interest dollars on the ones you have taken out versus I take out a fixed loan, which I mentioned in the past. I've done in the past. I don't recommend it, but you take a QuickBooks loan or a credit cards loan, those kind of things. You're paying interest dollars right away on that whole chunk amount, and then they want their money back pretty darn quickly when you would want to rather have it in your account. And all those things come from not knowing how much capital we need to save in our business. The book talks about having 2 months operational capital. For me, I mentioned last time, it was getting through winter and a spring marketing push. And then by setting aside on that skill, being disciplined in doing that, because Dad's going to come home and wrestle your butt to the floor if you don't save some food for him. Same with Uncle Sam, or same thing with the things that sneak up on us. I talked about being prepared. Okay, now, how much do I need to save? This is probably a great story. History is the best predictor of the future. How can I plan better for seasons, for scaling up? This is really interesting. How can I plan better? Well, this comes from actually having a dream first. And I find myself right now having a hard time finding a bigger dream, because I'm living things that I've never been able to have before. Be able to take my kids on a trip, 2 years in a row, going to Disney. I'm not bragging, but I've never been able to do that. I didn't get to do that as a kid growing up. So I really enjoyed that. But you have to have a dream. We'll cover more of that later on time. So then you can go, it would be possible if, and then work your way backwards, right? If I want to do, $2 million in revenue, what does $2 million do? Is it just $2 million with $2 million in expenses? I'm planning for profitability, but in doing so, I need to have equipment in place. We'll cover more in detail on that, but thinking ahead will do that. But sometimes we can't see the future. Remember COVID? Who saw that coming? Some of you did. I'm not saying anything. We're not going to talk about that and stuff. Please don't fill my comments for those things. But we sometimes can't see those things, or recessions. I don't even like saying the word of that, because it makes me a little nervous sometimes. But if we have some things set aside or set ahead, we can use recessions for an opportunity to buy things at a discount. All of a sudden, equipment and trucks could be cheaper because our suppliers are maybe going out of business, or other vendors, or also competitors. Those who ramped up, scaled up really quickly and highly leveraged, and when their customers start shrinking back their payments to them or cutting back their need for them, they could go out of business. And if you have cash saved up, you could be then buying other companies as well. That's something to always think about too, to keep in mind if that's what we're going to be going to. Let's see, I think that was the last thing I wanted to kind of cover here. And I am not a boatload of cash. I do not have tons of cash saved up to be able to do that to buy other companies, but I would like to, which means we're setting aside more and more each time and looking at our profitability. Okay, that's kind of what I want to cover on this one here. Am I taking so much out of the business that I'm having to get loans since there's no cash left? We just covered that a little bit there. And be careful. Some of us had to start a business because the business we were working in let us go. So we had to go out and start making money. Sometimes we can find that we want to take distributions out a little bit more because we needed to make payments. We just got to think of how long can the company do this, or when can I do this when I reach these certain goals? And that's kind of competition, something we're working towards. Just be kind of careful on that. All right, so tune in next time as we hit Chapter 5. Chapter 5 looked to be pretty darn good as well. Building on that foundation. You're going to build a big tree house in the backyard. It better be strong before it all falls down. So join me next time of Chapter 5. See you guys.